fees, where should we take that?
Allocated between TEI and rents.
Okay, how much goes to TEI?
It goes to one.
One, which is 1/5, goes to TEI, and where should we take the balance of it?
Rents.
Interest.
Interest. Beneficiary might want passive income. So typically, interest is the place where I would go first. Okay, so I'm gonna do that 4. Okay. And then, do we have anything else? Charitable. And charitable, guess what? 2, 2, 2, 4. It's gotta be rateable. Charity gets each class. So we've got 8.
It's too much though.
Sorry?
That's oh, I'm sorry. That's right.
4, 7, and 11. So let's take a look at these things. Throw out the TEI. What do you get when you add those 3 columns?
33.
Nope.
Oh, 23, sorry.
23, which equals?
TEI.
Right, when I throw out the TEI, you got 23. If I now include that, what's the total of those 4?
30.
Which is?
Your TNI.
Which is DNI. It also happens to be our FAI, but this is our DNI. Okay. And how much of the DNI is A going to get?
50%.
50%. A gets 15 out of 30, so 50%. So A is ending up going to get 4, 2, 3.5, and 5.5. And I might add, who else gets that? A gets that, and the trustee also gets that. Okay, so the taxable income of the trust and A attributable to the trust are going to be 4 plus 2, which is 6, 11.5 minus your personal exemption. And those categories. So let me tell you where I got those examples. The 2 examples I did last week and the example that I did this week. They are all in the regulations. Okay. Last week we did the 652 regulation example, the illustration, and we did the 662. 652 and 662 example. This one I did the 661 example. And I really should have done this example last week, and last week 662 example this week, because that one's a little bit tougher. But this one's fairly easy, relatively simple and straightforward. Okay. And again, it's just spotting these issues. Didn't have any separate shares here, but if you have separate shares, it'll get a little bit more complicated because you've got to keep those shares separate. Okay, and you got to look for, do we have income from this type or that type? Things of that nature. But ultimately, it's the exact same thing in all of these examples. Okay, just doing it longhand, flipping it, doing the chart, which to me kind of makes sense. This to me sets it out where the computations may not be quite as clear as to what we're doing. This is very clear as to what's going on. It's each category that we have in each slice of our DNI. Okay? What's the question?
We had another, the distribution deduction.
So the distribution deduction here is going to be this plus that, 11.5.
Because it's lower than the FAI.
I'm sorry?
Because it's lower than the FAI.
No, again, this is tier 2. So the beneficiary gets out 15, which is rateable. When you add those 4 things together, you get 15, proportionate.
Okay.
Okay, so, and you don't get a distribution deduction for this.
TEI.
So what ends up happening is you're going to get an 11.5 distribution deduction. You had taxable income of 23, not surprisingly, the trustee gets 11.5 of income. Half to A, half to the trustee. Okay, but had the numbers been slightly different, you could have gotten a little bit more, a little bit less. You're gonna get 15 over whatever the total amount of DNI is of each category. This is nice and easy, it's 15 over 30, which is half. But if you'd had 31 of DNI, then A would have gotten 15 31st of everything, and the trustee would have gotten 16 31st after the distribution deduction. Okay?
Can you do another example?
We'll do some at the one at the end. But let's go back to the materials. The other examples are a little bit easier. They're in the appendix. Okay, they're nothing terribly exciting. And by the way, also, one of the benefits of doing the ones in the regulations, and I used to tell people in the regulations, and people were following in the book and weren't thinking. And so it's actually better, maybe somebody figured out where they were and was following along, but just better to think about what's going on rather than just to look at the book and shut off and just read as to what's going on. And so the problem with the things in the appendix is that it's all kind of laid out for you, and you don't have to think, you can just look, which is, to me isn't quite as good and isn't too powerful, but we'll do it anyway. Okay, so trapping distributions. Trapping distributions are a way of spreading income over several taxpayers. Again, not terribly important or a big deal today because the brackets of various entities are not terribly significant, but kind of in your best case scenario, if you had an estate that had as a beneficiary a trust, that has a beneficiary an individual, and you'll say you had 300,000 of income at the estate level, there is a way to get 100, 100, and 100. Okay? There's a way, basically, to have the income shared, and if, in the olden days, when you had runs up the brackets, you'd want to do this. It'd be a great benefit, rather than having 300 taxed here, or 300 taxed here, or 300 taxed here. If you can have 100 taxed all over each one, then you get to run up the brackets, nobody's gonna be at the highest brackets, and you're gonna get your maximum tax savings. Okay? And this would be, to achieve this result, would be called a trapping distribution. Compression of brackets today, it's not nearly a big deal, but it's important that we understand how this works to figure out and to understand how the conduit system works, okay? And let's just say that this trust required all income to go out to beneficiary. So the question is, how would you, if you had 300 at the estate level, 300 DNI, how would you get it so that 100 can be taxed to the beneficiary and 100 can be taxed to the trust? What would you do? And 100 still taxed at the estate. Well, let's start with the easy thing. How much is our distribution going to be at the estate level?
200.
200. So how much are we going to have to distribute from the estate?
200.
200. Okay? And now the question is, what are we going to distribute from the estate?
Income.
Sorry?
Income.
Okay, so if we distribute income from the estate, where's it going to go?
To the beneficiary.
No.
It's gonna go to the trust.
It goes to the trust, and then
The beneficiary.
it's all going to go to the beneficiary. Why?
Because it's required, all the income.
Because all income is required to be distributed. So if we distribute 200 of income from the estate to the trust, it's going to ultimately go to the beneficiary, and so nothing's going to be trapped at the trust level. So that's not going to work. Any other thoughts?
So like 100 of principal and 100 of the income?
Okay, so if we do 100 and 100, 100 income and 100 principal, then what happens?
100 gets to, 100 goes to the beneficiary.
Which 100?
The income
The income 100 goes down to the beneficiary, why?
is required,
It's required to be distributed, and what happens about the 100 principal?
it's trapped in the trust.
It trapped at the trust level. So this is what you would have done, you would have distributed 200, being 100 of income and 100 of principal. The 100 of income is gonna go down to the beneficiary, and we're gonna get a distribution deduction at the trust level, and the 100 of principal is gonna be trapped and taxed at the trust level.
How do you pass down 100 of principal? How do you do that?
I'm sorry?
How would you do that? Like, what would
Here's
you,
100 of principal.
like, what would you distribute? Like, what would you?
I had 100,000 in a bank account, that's principal. I'm not giving you the income, I'm giving you the principal.
Whatever's considered corpus.
Yeah,
Okay, then how is that corpus taxed at the trust if it doesn't generate any gains and losses?
It's not tax of the trust.
well, it is taxed at the trust.
How?
How? The DNI got passed down, 200 gets passed down. So we have ultimately 200 DNI goes from here to here. Goes from estate to trust. And then from the trust to the beneficiary, only 100 DNI gets passed down. Okay, I'm not quite sure I understand what the question is.
I think you just answered it.
Okay?
I think you just, because we get the DNO, we get the distribution
You get a
deduction.
distribution deduction, so all amounts properly paid or credited. It doesn't have to generate income, whatever you distribute a house, as long as it's not a specific gift to carry out DNI. Okay? So we get then the $100 down to the beneficiary, $100 is trapped in the trust, and $100 never left the estate. And that would be called a trapping distribution. We don't generally do it today, but that's the principle, and understanding the consequences of making one type of distribution, i.e. income versus principal. Okay? If you want to do these things, there may be a way to achieve that result, vis-a-vis what you're distributing, and obviously how much. Okay? So in example 515, estate has dividend income of 100, no other items of income or expense. Estate made a $40,000 corpus distribution and to a residually simple trust. Now, by the way, corpus, it could also be, it says dividend income of 100,000, obviously it's got some stocks. So the corpus could be stocks here, doesn't have to be cash. You can distribute $50,000 of stocks. For the year end, the trust had 10,000 of dividend income, exclusive of the amounts distributed to by the estate. So meaning that the trust itself had 10,000 of dividend income. So this is what happens in this example. From the estate perspective, it had how much of income?
10,000, I mean 100,000.
100, again, all DNI, and it gets a distribution deduction for 40,000.
Correct.
So that it's gonna be taxed on the 60, less the exemption of 600, but roughly $60,000. The trust had 10,000 of income,
Mhm.
but it's gonna be taxed on an additional 40 of DNI from the estate. Okay, so that is 50, but then we're told that it's a simple trust. So it's required to distribute out the dividends that it received. So it has 10,000 in, plus the 40,000 from the estate, that's a total of 50,000. It's getting a distribution deduction for the income only, the 10. So it's gonna be taxed on 40,000. Again, we have the personal exemption of $300, reducing that amount slightly. And then the beneficiary will be taxed on the required income from the trust, which is 10. Yes?
The estate distribute $40,000 of principal,
Correct.
right? Why do they call it dividend? To me, dividend
Okay.
implies income.
Okay, anybody answer that question? Very simple answer. Leslie?
Because the estate has $100,000 of dividends, when they take the distribution deductions, it carries that dividend income, character to the trust.
Okay, that's exactly right. Forget about what's being distributed. Okay, the bottom line is, the estate has 100,000 of dividend income, right?
Mhm.
Okay, that's the estate. We have an amount properly paid, credited, or required to be distributed. In this case, $40,000 happens to be principal, but we have a tier 2 distribution. And it carries out DNI. It does not itself have to be income. Okay, that's how the tier system works. If you have an amount that's properly paid, credited, or required to be distributed, it will go out. It will carry out DNI unless it's a specific gift or a specific sum of money, payable in 3 or fewer installments. Okay? The distribution does not have to be income to carry out income vis-a-vis the DNI. Yes, no? Okay, you gotta just focus on the rules of the tier system and forget about the fact that we're not distributing income. You don't need to distribute income. A distribution of principal will carry out DNI, will in effect carry out income. So it's that simple. Does not actually have to be that income. We're not actually tracing the dollars in that for tier 2. For tier 2, it's any distribution will carry out DNI. If there's DNI left after the tier 1. Okay?
How do you know it's a tier 2 versus a tier 1?
Because it's corpus. Tier 1's only income, required income.
Okay, tier 1 is only, good catch, is only required income. Okay, is there a tier 1 in this picture?
You know?
Ah,
Well, the trust,
the trust has
tier 1.
a tier 1 as to the 10,000 dividend income that it has.
Mhm.
So that income is required to be distributed. The issue is that when the trust gets the principal from the estate, that's a principal distribution, it is not required to give that to the beneficiary. Even though it gets taxable income attributable to that, it doesn't have fiduciary accounting income that is required to be given to the beneficiary. So it gets a tier 2 distribution of principal, which carries with it DNI from the estate, and the trust is therefore taxed on that DNI, which is not required to be turned around and distributed out. Why? Because it's not income, it's principal receipt. Yes, no? Everybody understand that? Again, you don't need to actually have a distribution of income to carry out income. That's not, that completely, not completely, but it largely ignores what a tier 2 is. A tier 2 can be a principal distribution that carries out DNI. So that's that simple. You have to understand and accept that. Just the rules. Okay, but if you're always looking for income, you may not get the right results.
Okay, so,
Can carry out tier 2, which is the whole principle, I might add. Sorry, that's principle PLE. It's the whole theory behind trapping distribution, principal versus income. Distribution principal can carry out DNI, but it won't be treated as income that's required to be distributed by the receiving intermediary trust.
if the estate is distributing tier 1 distribution to the trust, let's say
Well, wait,
10,000,
what's the tier 1 distribution?
Required.
required,
Income.
required income.
Very, very, very few estates require income to be distributed. So your hypothetical was, if the estate has a tier 1, it typically won't. Okay, so now let's look at the private letter ruling 85-01-011. So this is what's called a Holloway adjustment, because the first case that dealt with this talked about Holloway's estate on page 65, which is a New York case. In California, and it's not in the materials, in California, we have a case that's exactly the same, but it's called the Bixby case. We may have talked about that before. I mentioned the Bixby case before? Anyway, the Bixby case is the exact same thing that they have in New York, and they just happen to have made a ruling based upon the New York case first, so this is referred to as a Holloway adjustment, as opposed to in California, it would be referred to as a Bixby adjustment. And the question is the following, that in this example here, who ultimately is gonna get the income?
The beneficiary?
The beneficiary. Okay, because California law says that if the income accrues beforehand, then you ultimately get it. You get the net income, so it may be net of income taxes, but you ultimately, if you're entitled to the income, you're gonna get the income. Even though you may not get it right away. It's not required to be distributed. So what's happened in this picture is, and let's just say, for the sake of simplicity, I'm not gonna use a 50% tax rate because then we can't figure things out, but let's assume a 40% tax rate. Okay? Who pays the taxes in this picture here with our trapping distribution? How much of taxes do the estate pay?
40.
40. How much taxes? How much taxes does the trust pay?
40.
How much taxes does the beneficiary pay?
40.
40. Okay. If we had distributed it all, what would happen?
What's it called, the beneficiary will get it all.
Okay, the beneficiary would get it all, would pay the whole 120 of taxes.
Correct.
Okay? So, ultimately, this 100, less the 40, is gonna go out to the beneficiary is gonna get that 60. Okay? But here what's happened, at the trust level, is that income, taxable income, is being taxed to the trust, and who pays who's paying the taxes there?
The trust.
Out of
The corpus.
principal. Okay, so the taxes here are being paid out of principal, and so that the income, when you later get the additional extra $100 of income here, is gonna go down to the beneficiary tax-free, because the tax is already paid here out of principal. And so the question is that appropriate? And ultimately, what private letter ruling 8501-011 and in the Bixby case in California and in the Holloway case in New York, they all stand for the same proposition, which is, no, that's not fair. Basically, if you do this and just let things stay the way they are, the beneficiary benefits to the tune of $40,000 because the principal beneficiaries from the trust have paid $40,000 of the beneficiary's income taxes by virtue of the trapping distribution. Okay, the $40,000 has been paid out of principal.
Correct. So
And-
that leaves 60, right?
What?
That leaves 60.
That
on
leaves
the
60.
Trust.
But the problem is it's principal, it's not income. So that if you look at the income picture here, remember we distributed 100 principal, 100 income. How much left of income is there? There's 200 more of income,
Oh.
which has only been paid 40 of taxes on at the estate level, so that ultimately what's gonna end up coming down is 160. Okay? This 40 got paid out of principal at the trust level. And so again, the three authorities, Bixby, Holloway, and this revenue ruling, not revenue ruling, private letter ruling, all stand for the proposition that what you do in these situations is that when this extra money comes out later on, it's not appropriate just to do kind of what it says at that point. Oh, now this is income, we're gonna flush it all down. No, what you say now is, look, the income beneficiary benefited by virtue of $40,000 of income tax being paid out of principal. And so now what we're going to do is we're going to charge the income beneficiary with that. So that when the 140 goes down, that we're going to charge the beneficiary with that. So the beneficiary ends up getting 120, which ends up being the right number. When the 120 plus the 60 there is gonna be 180. The beneficiary will end up not being unduly enriched by virtue of the principal beneficiaries of the trust paying the income taxes. And getting a few blank stares. Everybody see how if you didn't make this charge, the beneficiary would end up getting 160 plus 60 would end up getting 220 at the end of the day. Okay? And it's because this gets paid out of principal at the trust level. Okay, and so to avoid that result, to avoid having the income beneficiary being enriched by having somebody else pay ordinary income taxes, i.e. the trapping distribution at the trust level, we get to make an adjustment to the income that ultimately comes out for those taxes that were paid at trust level out of principal that really should have been paid out of income. Again, the other thing you have to remember here is you got different beneficiaries with different interests. You guys seem like you're good friends, but if Elizabeth's getting the income and Odette's getting the principal at the end of the day, you guys may not be, for that interest, you're gonna say, give me the income, and you're gonna say, no, don't give her the income. Or don't, don't pay her income taxes out of my principal, which is ultimately what's happening. Okay, this is a good place for a break? Okay, if you have questions after the break, we'll